For the banking sector, it's in the red today. Investors are rotating out of some of those cyclical names on worry over the economic recovery, but it doesn't sound like some of those worries are going to end anytime soon, because Dick Bove, he's out with a new call today saying that China could hurt big U.S. banks. So we want to bring him in and talk a little bit more about the note that he just released. And I guess, Dick, you write that the Chinese business operations in some of our largest banks, so JP Morgan, Citi, Goldman Sachs, Bank of America, Morgan Stanley, are at risk. Explain to us why.
Well, basically, as you know, there are about 72 offerings that are supposed to come to market from Chinese companies. And what happened with Didi could happen to any one of them. If that happens, then it would appear that companies like JP Morgan, Goldman Sachs, and on down the list are going to take a loss. But the real fear is not so much those 72 offerings. The real fear is that the Chinese seem to have reached the point where they believe that they don't need the Western markets in order to raise funds for their companies, and they may kick, the American companies out, or they may severely constrict what the American companies can do in in China. And if that happens, I think we're looking at a significant one-time earnings hit to these companies.
Well, you talk about in the note, too, how they went about doing this. For instance, the world would rely on the IMF, whereas the Chinese and Asia, they created the Asian Infrastructure Investment Bank. What does this mean for those of us in the States, though, whether we're investors in a bank or just for the strength of the dollar going forward? Are we going to be losing that leverage that we've had for the last 4 or 5 decades?
I unfortunately believe that we are, and I find it to be extraordinarily frightening. In other words, for the last 20 years, since the since China joined the World Trade Organization, it, along with Russia, has built a well thought out program to expand China's influence in the global markets. That includes, in other words, initially getting dollars as the backing for the Chinese currency. But, as time went on, the 4 biggest banks in China became the 4 biggest banks in the world. Further, instead of having only a few contacts with banks outside of China, Chinese banks now have contacts with thousands of banks. Going another step further, the Chinese have loaned money to 150 countries around the world, and the amount of money that has been loaned is so great that it's now estimated by the Kiel Institute that basically 6% of the world's GDP is owed to China. And then going another step further, they brought in the big banks in the United States. They gave them low-cost stock in their companies so that they could partner with these banks in generating, how you operate in the capital markets. And then about 7-8 years ago, all of the big banks sold their investments in the Chinese banks for what were profits in the hundreds of millions of dollars. The next step, of course, was that China then started to do these offerings on its own. And now we're looking at the possibility that they're going to say, well, we want you to operate in the yuan. You're a Chinese company. We want you to do it inside of the country. We want you to do it with our, if you will, companies. And we don't need you outsiders to come in either with your dollars, which we don't want, and we don't need you to come in with, your big companies making a big profit on our Chinese offerings.
Hey, Jay, more broadly speaking, let's just talk about what we've seen with banks since the start of the year, and then, of course, what we've seen in the last month, because it's been a little bit different. Of course, banks were among the leaders here since the start of the year, and then the past month or so, they've fallen a bit out of favor. I guess, what do you think? Do you expect to see a continuation of some of this weakness that we've seen over the last couple of weeks in the near term?
Well, it's Disneyland versus reality. Disneyland, which I'm big believer in, believes that in the second half of the year, we'll have a very strong recovery, that interest rates will rise, and that banking companies will make a great deal of money. The fact, however, is that none of that has happened, right? None of it has happened. Banks, if we take out the capital markets activity, which is just a very small number of very big banks, and look at the core bank earnings, they're terrible. I mean, essentially, loan volume has been declining. we're in a situation where commercial industrial loans are down 15%. That's not just a recession. That's worse than a recession. Mortgage loans are down 3%. Credit cards loans are down 1%. The yield curve is flat. We're not seeing the expansion in the yield curve. So what we're going to get is, if we look at the core earnings of these companies, they're not going to be good at all. Just as the way in the first quarter they weren't good at all. What we're looking at is accounting wizardry. In other words, basically, the banks built reserves to too high a level in the beginning of 2020, and now they're going to take those reserves down, and they're going to take those reserves down by billions of dollars, and that's going to allow them to show a reasonable earnings number.
Dick, real quick, because we only have literally about 20 seconds. What you just said, is that part of the reason you think Wells Fargo is eliminating its personal lines of credit?
Yeah, Wells Fargo is taking advantage of an opportunity here in which they're going to get rid of customers they don't want, and they're going to force the customers they do want into credit cards and personal loans. This is altogether positive for Wells Fargo because it's going to increase the margins on the loans, and it's going to get rid of people it really doesn't want.